Good day, everyone. Thank you for joining us again. My name's Darryl McCoubrey. I'm a VP, Head of Research and VP Infrastructure and Utilities here at Veritas Investment Research. My colleague Nigel and I, both of us on the VLIS committee, are going to provide an update on the VLIS positioning and also our outlook. Before we get into that, though, just a kind of reminder, a list of things that make the VLIS what it is. It's a model portfolio. It's only buy rated stocks. We do bottom up type research. That means we focus on, accounting adjustments and such, and I'll get into a little more detail later to try to get at actual levered cash flow or free cash flow to shareholders, last in line usually. We're concentrated. We can only go up to about 25 names by design, to as few as 12. I think we're at 19 currently. We measure ourselves against total returns, the S&P TSX Composite Index. Lower turnover, you'll see later by our allocation that we're sector agnostic, and we're looking at mostly larger cap stocks, better liquidity, and they should be in Canada. At the bottom, it says a list of golfing stocks. That's just our focused on risk-adjusted returns. We tend to try to avoid very large uncertainty that we can't grasp around on what would be an appropriate return with comparable assets. The process, kind of our secret sauce, if you will, how we come up with our ratings at the firm. It starts with accounting and disclosure review, with an independent analysis that attempts to right-size kind of non-GAAP, non-IFRS metrics like EBITDA and EPS, etc., into actual cash-based metrics that will drive valuation by our discounted cash flow approach for most stocks. Once we have a good bearings on kind of where we are, and we build out our forecasts through research and time, we're then going to compare returns of that stock, all that work we've done, to other stocks that we think might be comparable risk or different risk. And that's where we try to make a decision, which is the third stage, which ones sound most appealing, which ones seem to give us the best risk-adjusted upside potential. This is our team of independent experts. They drive that bottom-up accounting and disclosure-focused research process that I've described. As you can see, we have pretty broad-based coverage of sectors across the TSX, covered by what I would call industry experts. And so we feel pretty well grounded when we're doing these type of comparative analysis of risk-adjusted returns. With that, I'm going to turn it over to Nigel, and he can discuss some of our historic performance and also our positioning currently.
Thank you, Darryl. So on this slide, we have highlighted our VLIS model portfolio performance versus the S&P TSX benchmark. As you can see, the VLIS model portfolio has performed fairly well, both on a year-to-date, 1 year, and 10-year basis. We've also managed to consistently outperform the TSX S&P Composite since inception. And on the next slide, when we look at what underpins that performance, it's our buy and sell ratings across our coverage universe. And that also tends to outperform over shorter time periods within a year, as you can see by the spread between a buy and call rated names over 30, 60, 90, 180, 360-day periods, and as well as the spread between a buy and sell rated names since inception. So for 25 years, our research coverage has consistently generated outperformance in alpha versus the market. And on the next slide, we can break that out even further and look at our buy, reduce, and sell ratings. Our buy ratings are stocks where we expect the company to materially outperform peers, or we expect significant upside. And you can see that our buy rated names have materially outperformed the S&P TSX return. Our reduced rated names are companies that are expected to underperform buys, but we don't see material downside risk. And those names have underperformed our buy ratings, but have still outperformed the S&P TSX. And lastly, our sell rated names, stocks that or companies that we expect both to underperform and where there is more material downside risk, have underperformed the S&P TSX by a substantial margin. And the foundation of this research is what helps drive the construction and outperformance of our VLIS model portfolio. Now, on the next slide, we've broken out the sector allocation for our VLIS portfolio. Generally, our portfolio tends to be more defensively oriented, particularly in recent periods due to elevated macroeconomic uncertainty. That said, our allocation to defensive sectors such as staples, utilities, or cash has declined in recent months, and that's driven off a removal of two Alberta power names, Capital Power and TransAlta, due to rating downgrades by our covering analyst. We also made another recent change in the V list where we swapped Hydro One for ATCO due to expectations of higher risk adjusted returns for ATCO within the utility space. Now, that being said, although we are underweight defensive sectors, if there is more positive macroeconomic developments, we do have some cyclical exposure and should benefit from our allocation to the energy sector. Now, with that, I will move to the next slide and pass it on to Darryl to wrap up.
Yeah, thanks a lot, Nigel, and then thanks again for everyone who's joined us. We'll be back with another update next quarter, and look forward to giving you our outlook then. We'll talk to you soon, and bye for now.
Thank you, everyone.